So let's get started today. So today we have Carissa and Megan and Dee. And Dee, I'm sorry, I don't have your bio, but I will read Carissa and Megan's. But thank you for coming today. So Carissa Habsburg is the tax manager with Sisterson and Company, LLP. Her experience includes tax returns, preparation, and review for corporations, partnerships, and individuals. Carissa is a member of the firm's emerging growth team and works with clients in a variety of industries with an emphasis on startup and technology companies. And Megan, thank you for coming as well. She is also a tax manager with Sisterson and Company, LLP. Her experience includes tax return preparation and review for corporations, partnerships, and individual. Megan works with clients in a variety of industries, including emerging growth, real estate, and service companies. She specializes in multi-state taxation and compliance, helping her clients determine their state tax exposure. So I will let you guys get started.
Thanks everyone for joining. I will be the one presenting today. Again, my name is Carissa Habsburg, and there's a couple members of the Sisterson team here. Dee Palashchak is one of the tax partners here at Sisterson, who also works heavily with startups, individuals, high growth companies, especially as they grow. There's just a lot of things that you guys just don't know that you don't know. And that's kind of the fun part about what we do. What I will do is I will share my screen and go through the presentation. I do see that there is no one on camera, and that is okay, but I'd love if you guys don't mind to turn your cameras on if you're willing. Sometimes it makes presenting to a face every once in a while more enjoyable. Also, I encourage if you guys have any questions throughout the presentation, please do just raise your hand or shout out any conversation. That would be absolutely perfect if that's okay. Okay, so with that being said, I'm going to share my screen and I will start the slideshow. That's okay. All right, ladies and gentlemen, as you'll see, there are plenty of things that when you start a company that you might not know or think about. If I may, before I dive in, if anyone's willing to share, do you have an entity set up? And if so, what type of entity did you choose? If anyone's willing to share. Okay. Well, two of the main entities that I often see created are C corporations and LLCs. Okay. And C corporations and LLCs both have different tax structures such that there are different tax rules on whether or not income and loss either stays with the company or whether or not it gets passed out to its owners. And I have an example on a couple slides going forward, but in general, those are the two types of entities I see in the startup world when you're creating your entity. A C corporation in general is an entity that is taxed in and of itself. It does not pass income or loss out. All tax is at the entity level. And that first level tax, that federal income tax rate of 21% under present law, is the first layer of tax. The issue with C corporations that most people try to avoid is the concept of double taxation. And that second layer, that capital gains tax of a maximum of 20% under present law, is where they hit you with that extra layer of tax. So if you go to pull the money from the entity, rather than reinvesting it, you're left with only about 62 cents on the dollar after those two layers of tax, $21,000 if you make $100,000 worth of income, taxable income, and about $15,800 for capital gains tax. Not to mention Pennsylvania's corporate tax rate is 9.99%, right? So C corporations tend to be a little bit more heavily taxed, but there are some pros to C corps, and we'll talk about that in a few moments. Another entity that I often see are LLCs. Okay. And part of the reason why people decide to invest in or create an LLC is they understand that the income and the loss passes out to the owners. Okay. And I like to give a little bit of an example here because it kind of drives the point home. And this is an area where I often see startups not necessarily having their tax returns prepared correctly. In this situation, just to give you an example, let's assume that there's $100,000 worth of income earned, and there's 4 owners, 3 individuals and a not-for-profit. And we'll call that not-for-profit CMU, right? CMU is technically a not-for-profit. And that $100,000 was contributed into the entity by CMU. They're the ones that are funding your endeavors. It's very nice of them, right? Right. So how is the income passed out to its owners? Absent anything in the LLC agreement, the income would be passed out equally, okay? Each owner owns 25%, therefore they each get $25,000 worth of income. Easy enough? Well, let's flip the example. Let's assume that they lost all of that money. There is no revenue generation whatsoever, and they spent all that money, so the tax loss is $100,000. If all of the facts are the same and the nonprofit CMU is the one that's funding the loss, you might think all 4 of those owners would each get $25,000 worth of loss. But that's actually not how tax law works. The IRS has a lot of rules, and they say in this situation that if you lost money, whoever pays for that loss gets allocated that loss. And in this fact pattern, the not-for-profit will get that loss allocation. Why do I bring this up, you ask? Glad you asked. The reason why I bring this up is sometimes startups form as pass-through entities, like an LLC, with the idea that they think they might be able to take that loss because they own 95% of the company or whatever, and use that loss to offset other sources of income. Maybe their spouse has a W-2 or something like that. That is not the case. So my point to this discussion is just be very careful of how losses get allocated. And this is something that should be addressed even early on in your life as an entity, okay? So I'm gonna go back to this choice of legal entity and type and talk a little bit about C corporations for a few moments longer, because C corporations are actually something that we see a whole lot more often as the entity develops. Some entities choose to start as an LLC, and then you can actually convert later to a C corporation. When you're an LLC, the catch to being an LLC is you are not allowed to be on payroll as an owner. In other words, you do not get a W-2. You get a gross check and have to pay taxes and pay your estimates quarterly. We're going to talk a little bit more about that later, but LLCs do complicate your life a little bit. Okay. Another reason why C corporations tend to be a startup more commonly in the startup world are there is something that investors need to get if you're an LLC from your tax return before they could file their return. As an LLC, the entity passes the income out to its owners, okay? And so the owners get what's called a Schedule K-1 from the entity that they need to use to prepare their return. Institutional investors don't want to wait for you to get your return done before they can do their tax returns. So C corporations tend to be a requirement for institutional investors to decide to invest in you, okay? At some point, you might consider converting if you start out as an LLC. It's not difficult to do, but there is some legwork and legal cost associated with that, okay? The last thing that I'll say about C corporations, and then I'll take questions if there are any, there is something that's in the law that really does incentivize the creation of C corporations. And I'm not going to use a lot of code section during this discussion, but if you remember nothing else from this conversation, write this down, guys. If you remember nothing else from this conversation, Code Section 1202, Exclusion. And here's what it says. If you're a C corporation and you hold your stock in that C corporation for 5 years, not 4 years and 11 months, but 5 years, and you're an individual who sold their stock after 5 years, each individual owner can exclude, under present law, up to $10 million from federal capital gains tax. This is a home run. And this is not one of those things that never happens. I had 3 clients this year that sold their company for millions of dollars and was able to take advantage of this. My point is there's some tax planning opportunities surrounding this. The first of which is you have to be a C corporation. And becoming a C corporation sooner rather than later might be something that you want to consider if you are looking to grow and sell your business, to start that 5-year clock from starting, okay? The second planning opportunity is that you have to sell your stock. And an acquirer would much prefer to buy your assets, not your stock. That's something that can be addressed at a later date. But the third item that I want to point out is sometimes in the startup world, you guys incentivize your people via stock options. Sometimes this might incentivize your people to exercise their stock options a whole lot sooner, okay? But let me give you a dollar example of really what this means. So in my example before, let's say you have 4 owners and you're a C corporation. And the 4 owners of the C corporation each own 25% of the company, and you sold your stock for $40 million. If 3 of the owners are individuals and 1 is a not-for-profit, all 3 of those individuals would each get their $10 million free of capital gains tax, right? They each get $10 million, 1/4 of the $40 million sales price, and they would be able to exclude from federal capital gains tax $10 million apiece. Again, it's a home run. And I bring it up now because, again, the creation of the entity type is just an important thing. So before I move on, does anyone have any questions, concerns, complaints at this point? No? Thanks for the shake of the head. I appreciate that. The last item on this slide is something called an 83B election. And I won't spend too much time on it, except to say that this 83B election is something that's needed if you have restricted stock or units, where there's a vesting. You get your shares or units over a period of time, maybe 3 years or whatever the case may be. This 83B election is prepared by your attorney, but you have 30 days from the date that you get your units or shares in the company to file this with the IRS. And basically what you're doing with this election is you are converting future appreciation to capital gains tax. That's the first thing. The second thing is that you are telling the IRS that you're paying tax now rather than as the stock vests. And if there's a value as the stock vests, you would have ordinary income to pick up without the cash to pay for it. Now, to take a step back for a moment, you guys might understand that ordinary tax rates are higher than capital gains tax rates. The highest ordinary rate right now is around 37%, but the highest capital gains tax under present law is about 20%. So as your shares vest, if there's a value determined to be on those shares, you have ordinary income to pick up at that vesting tranche without cash to pay for it because you're not selling your stock. This 83B election is a no-brainer in the startup world. If you remember nothing else from my talk about 83B elections, do not forget to file it because it can cause some unnecessary heartburn in the future. Okay. A signed copy of this 83B election also needs to be attached to your entity's tax return. And if you have legal counsel that works with startups often, this is not something that they'll miss. This is something they do day in and day out with startups, okay? Unless anyone has any questions, I'm going to thumb through and talk a little bit about payroll taxes. Okay. Payroll taxes in general are a beast in and of themselves. My recommendation is do not try to do payroll yourself. I can tell you some horror stories. Don't do it. It's a trap. Don't do it. Now, there's different rules for owners of LLCs versus owners of C corporations. And I already hinted a little bit about the rules for LLCs. As an owner of an LLC, you are considered to be self-employed. Now, what that means is you're not allowed to get a W-2. Do not put yourself on payroll. You get what's called a guaranteed payment. And that guaranteed payment has no taxes withheld. But you as an owner are required to pay taxes on that guaranteed payment quarterly, your federal, state, and local taxes. That's a little bit of the heartache of being an LLC. Yes, you can pass the income through, but you're not allowed to be on payroll. Okay. As an owner of a C corporation, you are allowed to be included in payroll. So that does make C corporations a little bit easier in the long run. Okay. You might pay a little bit more taxes, but early on you're losing money. So the losses might not necessarily matter to you, especially if you're not funding those losses. Okay. If you have an employee, that person should be included in your payroll. And the concept of employee versus independent contractor is a well-discussed item. I don't know that I have to spend too much time on that. And there's plenty of, if you Google it, it's an issue that's been out there for so many years. But the concept I want to point out is if you control what that person is doing, if you're telling them where to work, when to work, how to work, 9 times out of 10, they're your employee and they should be included on payroll. The catch is now having to set up payroll is not ideal because it's an added cost for the company. So more often than not, companies try to treat their people as independent contractors. Practically early on, I understand, but be very careful because if the Department of Labor was to come in and audit you, this is a very hot button in the IRS eyes. I usually get a question, what about interns? They're only working 10 to 15 hours. Well, in general, interns couldn't do what they're doing without your supervision. They couldn't do the tasks that you're trying to get them to do without the input that you are doing. They're not holding themselves out. They don't have a business card to do this for other people. 9 times out of 10, that intern is your employee. Now, technically, you have a requirement to put them on payroll. Okay. Again, that decision is certainly up to you guys. If you have an employee, you should request a form I-9 from that employee. And you may have seen this at some point in the past, but it's that form that tells you that they have a right to work in the United States. And you request 2 forms of ID. Maybe it's their driver's license and their birth certificate or something like that. It's just kept on hand and it's provided to the Department of Labor if they were ever to audit you. So that's the I-9 for employees. The second item is for an independent contractor. Before you pay that independent contractor, you should get a W-9 from them. That W-9 is needed in order for you to be able to prepare the form 1099 NEC, non-employee compensation, that they will get at the end of the year for what you pay them. Let me tell you, if you tell them they're not going to pay them until you get this W-9, they'll give you the W-9. Because what happens is 5, 10, 8 months down the road, they're not doing any work for you and you have to fill out this 1099 and they just don't respond to you. You must issue them a 1099, but you need that information. Best practice, get a W-9 before you pay your independent contractors. The last item that I have on this list is a W-8BEN. And this is for independent contractors, but this is for foreign independent contractors. Those independent contractors who do not do work in the United States, you should get a W-8BEN, because if you don't, and this is a foreign person, you have a withholding requirement. The company has a withholding requirement on the amount that it pays that foreign contractor. And you have a responsibility not just to withhold it, but also to remit it to the government via special forms. I'm not going to go down that path too far, but if you do have foreign contractors, please make sure you get this W-8-BEN. The last item I'll say about payroll, ladies and gents, is do not pay anyone before you have a system in place. You don't want to pay an employee and then have to go back and fix it and ask for the employee for company money back if there's taxes that should have been withheld. There's so much included in payroll that if you don't outsource it and do it right the first time, you will regret it. And again, I could tell you horror stories, but that's not what this is for. So before I go on from a payroll perspective, does anyone have any questions on payroll or payroll taxes? Okay. You guys are exciting about taxes, right? Taxes are so exciting. They are, you just are going to rack up your questions at the very end and ask all of them then. Yes. Okay. Sales and use tax. Sales and use tax are things that are coming into a decent bit more scrutiny because of a Wayfair case. And you guys might know a little bit about Wayfair. Wayfair is that online retailer that sells furniture and fire pits and whatever else you want to get from this online retailer. But every state across the country is looking for a piece of the pie. They're dying for revenue. And one of the ways that they're doing this is by looking to collecting sales tax on sales of tangible and intangible property across the country. This Wayfair case basically sent ripple effects across the country, and even small businesses like you who don't set foot in another state might have a sales tax filing requirement because of this. Here's what happened. Wayfair is an online retailer who had no nexus, no sales tax collection requirement in South Dakota. South Dakota didn't like that and took them to the Supreme Court and won. And the reason why is they had an online presence, but they had no physical presence in South Dakota. But they were selling to South Dakota customers, and South Dakota wanted a piece of that pie. As a result, because Wayfair lost and South Dakota won, thresholds have been set up across the country to basically say, if you sell any product or services, which software as a service is what I'm referring to here, into a different state, you may have an income tax file or a sales tax filing requirement. And those thresholds tend to be 200 transactions or $100,000 worth of revenue per state per year. Every state is different. Every state has different thresholds, but generally it's not going to be less than that. There are like maybe one or two, but I'm just pointing that out, that your goal is to get a tracking system in place for revenue based off of customer location. You should be able to track that at any given time to make sure that you don't trip these requirements to file a sales tax report, which are quarterly reports usually. Software as a service, a SaaS-based company, you may still have sales tax collections, even though services don't always require you to collect and remit on those. More and more states are jumping on board saying software as a service is a sales taxable item, okay? Long story short, pay attention to it because you do not want sales tax to be the issue that comes up in due diligence. If you're looking to be acquired, sales tax is one of those items that will be a large item on the due diligence listing, okay? Just get a process in place early on so that as you grow, it can be tracked. Sometimes if you purchase things from out of state and you did not pay sales tax on it, Pennsylvania, if you're located in Pennsylvania, might say you have to pay what's called use tax. You may or may not get a questionnaire about this from the state. Be careful of those questionnaires, because they're trying to catch you to see if you should have been paying sales tax when you should. Okay. Oftentimes too, you might get questionnaires from other states. If they know you're doing something in their state, maybe you registered with the state to do something, they might start asking questions to say, should you be collecting sales tax? So you might get a questionnaire. It's called a nexus questionnaire. Okay. Any questions about sales tax? The only thing I will add is if you are selling a physical product, before you have your first sale, you should check to see if you are required to collect and remit sales tax. You don't want to have to go back to the customer and say, oh, by the way, you owe me $70 because I didn't charge you sales tax. They're not going to pay you. And if they don't, then you have to pay it as a result. It's going to come out of your pocket. If you are developing a widget, a physical product that will ultimately be sold to the end user, a customer, there's an exemption form that you can provide to the manufacturer of the piece components that go into that widget, so you don't pay sales tax on that. The goal is to pay sales tax only at one stage of the sales process. And if you're selling to the end customer, that's where it gets charged. You should not be paying sales tax if you're going to charge sales tax to your ultimate customer. And that form I have on this slide, it's called the REV 1220. All right. Any sales tax questions? Okie dokie. Accounting. So in general, there are various.
Hi.
Oh, yes.
Sorry, I was trying to unmute myself.
Go back. Yes.
So if, let's say, a startup is using some sort of government grant money to deliver a service or a product to one of the government entities, are they also liable for these sales tax and use tax issues?
So if your customer is a government that you're selling to, is that what you're asking?
Mm-hmm.
And you've determined that your product is taxable, you should be charging sales tax. Let's say you're selling to someone that's not just a government, right?
Okay.
You've determined that this is a sales taxable product. Any person who is not required to remit sales tax to you, like a government institution, should give you the REV 1220. And you keep that on hand to say, hey, I did not charge this person or this entity sales tax because they presented to me an exemption form. That's your CYA there. That's a very good question.
Thank you.
Sure.
And I think there's a question in chat as well.
Oh, thank you. Sorry. Any additional forms other than Form I-9 that are required for hiring foreign students with an F1 visa as full-time interns? So in your payroll system, there are other forms. A W-4 to get their information is required. An F1 visa or green card holder, there are different rules for those individuals. And the ability to include them in payroll should be a discussion. We can have that outside of this seminar. Your payroll, let's say you use Gusto, for example, they will be asking for those forms in order to set them up on payroll. But a W-4 is another form. Okay.
Can I ask a question since we went back to payroll?
Yeah.
So if you are pre-seed or pre-revenue, like how do companies typically pay interns?
So there's a technical right answer, guys, and there's a practical right answer here. I am being recorded. So the technical right answer is that you should be setting up payroll if you are controlling what they're doing. Practically, I understand that that is not always what happens. And if that's the case, at the very least, you should issue a W or an a 1099 to that person, but that is not the technically right answer if you are truly paying who should be considered an employee.
Got it. That's helpful. And then after incorporation, do the owners need to be paid anything? I know you mentioned for LLC, like it might not be, like you might not need a W-2, but if you're, let's say, a C Corp, do you need to, is it mandatory to pay at least a minimum wage to the owners or any of that?
No, it is not required to pay the owners. And often early on, you guys do everything for free. That's the name of the game, right? Because cash is king. You're not required to pay any minimum amount, especially with the size of the entity that you guys are. But if you do go on payroll and if you are a C corporation and you're an owner, you do not get a 1099, you get a W-2.
Perfect.
Thanks for asking questions.
Thank you.
Yeah. Anyone else? Okay, I'll flip forward. So I'm going to talk a little bit about accounting, the debits and credits, the most exciting topic that you guys can ever dream of, I'm sure. But this is so incredibly important because as you grow your business, there are going to be so many people asking for your financials, right? Your profit and loss statement, your balance sheet, your statement of cash flows. All of those statements are so important. And if you have to tell your investor, hold on a second, let me get my books together. And then a week later or 2 weeks later, that's when you present these financial statements, they're not going to get a very nice taste in their mouth. So with that being said, making sure that you have a system in place that you can produce certain financial statements in relatively short order is so incredibly important. More often than not, most people use something like QuickBooks or QuickBooks Online. There are other systems out there, but I will say that it's a garbage in, garbage out concept. Sometimes the free models or the freemium models are not always the best way to go about it because they don't have as much of the features that you might consider or need to present to an investor. QuickBooks Online, I'm just going to talk about that one because I'd say about 90 or 95% of my clients use that. I think that it's great because it links to your phone. You can take pictures of your receipts and it links directly to your bank account. So as it downloads the transactions, it'll try to code it. And all you got to do is hit accept and it puts it to the various categories. I do often see Excel used in the first year, but as long as you can categorize your receipts and disbursements by category and it reconciles into your checking or credit card account, that is key, okay? What you should do, and I know that this sounds somewhat oxymoronic, but please do bear with me, business versus personal. Try to create your own business account. Do not commingle your business and personal because the IRS will scrutinize that a whole lot more heavily. And so too will your investors, right? Your investors want to make sure that the money that they're putting into the company is spent on what it's intended to be used for, okay? Saving your receipts, attaching your receipts to the transaction. A credit card statement is not sufficient in the eyes of the IRS to support a transaction, okay? You should have receipt support that can either be attached electronically, like I said, via QuickBooks, or even saved in Box, Dropbox, whatever your system is. Anything that is equity, debt, grant related should be kept in perpetuity, in my opinion. Whereas most everything else has like a 7-year timeline. They usually say to keep things at least 7 years. The IRS has 3 years to audit you, okay? So that's statute of limitations. You have to at least keep things for 3 years at least, because if the IRS was to audit you and you were not able to provide the support, they would likely disallow that deduction, which could cause you some tax issues, okay? The last thing that I'll say from an accounting perspective is if you do have inventory, please do not use Excel. It's not worth the trouble. Inventory tracking and all of the things associated with it, you need to have a software in place, okay? I do see it happen, at least in the first year sometimes, But usually after the first year, inventory becomes a little bit more burdensome in the tracking and what you're selling versus what is still on hand, and so on and so forth. Any questions from an accounting, debits, credits perspective? Yes, Raj.
Yeah. So your personal versus business account question, I'm sure you hear this often. When we're starting out, we have made a lot of, expenses from our personal accounts. Is there a best practice in terms of, do you then transition those costs over to the business? How does that need to be documented? Are there any technicalities that we should be thinking about?
Yeah, so that's a great question. Those expenses, if you would like to include them in your business return, if you deduct them, the receipt support becomes property of the business. Okay. And I see those expenses put on the books in two different ways. One via an equity contribution. Okay. So you debit the expenses and you credit your capital account. And that is done because it's usually considered the owner's sweat equity. Investors they would prefer to see it as that than the second option, which I'm going to say as a loan, with the expectation that if an investor puts money in, the other owners might get repaid for the time and money that they put into the entity. I have seen it start out as a loan and then get moved to equity if an investor puts up enough stink. But in general, when an investor puts money in, they want to see it looking towards the future of the company rather than paying back what was put in by that owner originally. So I do see it in general, like I said, as an equity investment, sweat equity in that word. Thanks, Raj. Anyone else? Yeah. Okay. Debits and credits, in my opinion, are, you might not know all the debits and credits, but making sure that you have something like QuickBooks or something similar to help you through that process is just really, really important. Okay. A couple other early stage issues. Early stage issues pertain to all of you guys that either have created or will create a business. And I say that because if you haven't done some of these items and your business is already created, you might consider doing that. So with that being said, if you're operating out of Pennsylvania, Pennsylvania has something called a PA Form 100. And it's like Pennsylvania's one-stop shopping to registering for your withholding account number for payroll. If you have to register for sales tax, this is where you would do it. If you were registering to do business, this is where you're doing it. My point to bringing this up is legal counsel will not do this. So if you think legal counsel did, you might want to double check that. But I caution you guys, do not sign up for sales tax account numbers if you know that you don't, or if you don't know that you need it yet. Because once you sign up for it, you're required to file zero balance reports, even if you have no sales transactions. What I mean by that is you can go in later and you can register for these sales tax account numbers, but don't just go in and blanket register for everything, okay? The same comment goes with withholding taxes. If you're not setting up payroll yet, do not register for a withholding account number, because if you do, they're going to be looking for reports. And all of those reports that I've just mentioned are quarterly. And then there's also an annual report. Okay. Pennsylvania and the IRS will send you welcome letters, and they both have your name and EIN and ID numbers on it. Please keep those. You'd be surprised how many people don't keep these things, but it's very important, okay, because they need it for the income tax returns and payroll and all that. Convertible debt. Convertible debt in early stage companies is extremely common, especially before your pre-seed, before your seed round, okay? And basically what convertible debt is this is some person or entity who's willing to give the company money via a loan. And on that loan, interest accrues. And then at some point in the future, that interest and principal converts from debt to equity at a stated rate. There's usually some discount associated with it. Where you don't usually, where some of my startups kind of don't understand some of the nuances are as interest accrues, that interest, even though it's not being paid to the note holder, it is considered income to that note holder. And I bring this up because the savvy investor knows that this is income to them. And they will likely understand when they get a 1099 OID telling them that it's income. But if your uncle, who is not the savvy investor, gives you $100,000 at an 8% interest rate, and he gets a 1099 OID with $8,000 worth of interest, he might not be so happy about that. So my point to this is if you have any convertible debt with an interest rate associated with it, you should get a W-9 from them so they know, and let them know they might get a 1099 OID for this interest accrual. Okay? Even though it's not paid until conversion. I have plenty of documentation if you're interested in all the tax mumbo jumbo, and I will send it to you for your midnight readings when you're up at night. Okay? Any questions about convertible debt? Okay. Stock options. Stock options are incredibly common in your world too, because you often can't pay your guys and gals what they would normally be paid if they went somewhere else. Stock options are issued to employees, but they're also issued to investors or advisors or people who are not necessarily your employees. There's different rules for ISOs, incentive stock options, which are issued to employees, versus non-qualified stock options, which are issued to everyone who are not employees. Be proactive on this front. If you have any questions specifically about stock options, I'd be happy to chat, but that's actually a whole nother class entirely. So whoever your tax preparer or advisor is should at least be talking to you about it. And there's different rules on when tax, if tax is due, and what type of forms need to be filed. Okay. The last item that I'll say is, when does business begin for tax purposes? And you might say, well, wait a minute, I started a business, my business has begun. That's not how the IRS works, unfortunately. The IRS has a rule that says, until you can say, hey world, come buy my product, you are not allowed, you're not open for business. And what that means is you are not allowed to take certain deductions. What I see done incorrectly sometimes is you put all of your expenses on the return, you deduct all of those expenses, and then you say, all right, I'll either pass it out to the owners if I'm a pass-through entity, or that loss will carry forward if you're a C Corp. That's not always allowed. Some of those costs are required to be capitalized and accumulated until you begin business. And what I mean by that is they get collected, and then once you begin business, they get spread out over 15 years. You don't lose the deductions, you just can't take them immediately. This is something I see done incorrectly quite often. My point of this situation is just be careful on what types of deductions you are taking. The exception to that rule is research and development. And usually I say, well, wait a minute, that's all I'm doing. Well, no, technically you're not. You're looking at marketing, you're looking at customer acquisition, fundraising, there's rent, maybe meals, travel. There's so many other expenses that are not considered research and development that can get caught up in this rule. Okay, so just be careful. All right. I did see a question come up from Bruce regarding the 1099 OID example of the uncle. Are individuals cash basis taxpayers, so it wouldn't be income? So glad you asked that question. Yes, individuals are tax basis cash payers. And that would be true if this interest didn't fall into a different code section. In this situation, as interest accrues, because it will eventually convert to equity, it is considered income as it accrues rather than as it is paid. Bruce, I'd be happy to send some information to you as a follow-up to this. Shoot me an email. My contact information is going to be at the very end, and I'll send you some literature associated with that. Yeah. Okay. Did see another question. Are advisory shares different than regular shares? So an advisor can be issued common stock if you're talking about a C corporation, just as any other person can be issued common stock. My comment for advisors was for stock options. There are different types of stock options, and an option is the ability given to someone to potentially buy stock in the future at what would likely be a favorable discounted rate. That's what an option is. And if you take a look at the differences between incentive stock options and non-qualified stock options, the difference is basically who can have one or the other. Employees are the only ones allowed to have incentive stock options. Advisors and everyone else are the ones that are allowed to have non-qualified stock options. Those options could be options to purchase common stock, but you are allowed to have different classes of stock. You can have preferred stock, and there's different levels of even common stock. The exception to this, by the way, is S corporations. And I don't know if anyone here is an S corporation. You are not allowed to have more than one class of stock for S corporations. That was a little side note. We might be getting too far into the weeds there, but just letting you guys know. Bruce, did I answer your question? And I think it was Michael. Did I answer your question as well?
You did.
Beautiful. Or Michelle, rather. Sorry, Michelle. One new message. Good stuff. Okay. So I'm going to move on. And at this point, I'm going to talk a little bit about tax credits. Okay. And in my opinion, tax credits in the startup world are so important. And as a startup, you might say, well, wait a minute, I'm losing money. Why would I even want a tax credit? Glad you asked, because I'm going to tell you. Tax credits in general are used to offset taxes owed. But if you're not making money, why would you want a tax credit? Well, in some situations, like this Keystone Innovation Zone tax credit, this KIZ tax credit, this is a Pennsylvania credit, okay? And this credit, if you don't need it, can actually be sold for cash at around 80 to 90 cents on the dollar. And there's a very ready market out there for this. Here's how the KIZ tax credit works. If you are inside of one of two geographic zones, one's the Greater Oakland and one's the Pittsburgh Central, and you're doing something technological in nature, which in general, most of my guys and gals are. This credit is calculated based off of an increase in revenue year over year. So, for example, let's say in year one, you have $1 worth of revenue. Just to make my example really easy, guys. And let's say in year two, you have $200,000 worth of revenue. Now, included in that can be grants, it can be actual revenue, prize money, all that kind of stuff. The max credit of $100,000 would likely get awarded to you because the way that it's calculated is 50% of the increase year over year. So $200,000 versus $1 is pretty close to $100,000, 50% of that, yeah? Like I said, there's a very ready market out there for the selling of these credits, but what do you have to do? You need to make sure to register to make sure you're inside the zone. And there are some annual reporting and semi-annual reporting requirements that you need to be on top of. But most importantly is you must apply for it. And it is due each year, December 1st. They just changed those due dates, so be aware of that. KIZ Resources is an entity who helps clients, my clients among many others, fill out this application, make sure they're doing what they're supposed to be doing, and then they also broker the sale of these credits. Okay, like I said, 80 to 90 cents on the dollar, it's free money. If you're already doing what you're supposed to be doing, you might as well get free credit for it, right? Any questions for this tax credit? This is a PA only tax credit. Okay. The next credit I want to talk about, which usually you guys are all doing this, is the research and development tax credit. I'm going to separate this into two categories. There's a federal tax credit, and then there's a Pennsylvania tax credit. What qualifies for the federal generally qualifies for the PA. The catch with the PA piece is the work has to be done inside PA. PA is trying to incentivize PA development, right? So here's what qualifies for this credit, ladies and gentlemen. 3 categories in general. Wages that you're paying for the proportion of time spent doing R&D. Independent contractors, if you're outsourcing the R&D. Supplies that are consumed in the R&D process. Okay, those are the 3 main categories that qualify for the R&D tax credit: wages, independent contractors, and supplies. The independent contractor piece is limited on how much qualifies for it at 65% of the actual cost. But the only other qualifying piece that I want to make sure that you guys are aware is that it has to be US based. The IRS is trying to incentivize US development, not foreign development. Okay. The federal credit is part of your entity's tax return. It is part and parcel to the preparation of the tax return. And there's a special form that gets included in the entity's return. You might still ask, well, wait a minute, I'm a startup. I'm not making money. Why do I need a tax credit? Well, this federal tax credit can carry forward 20 years. Okay. But you can also make an election to use this credit to offset the employer portion of the Social Security taxes. Basically, what you're doing is you're monetizing this credit a whole lot sooner by making an election. And if you have payroll, even if you don't, you can still make this election. But what will happen is it'll carry forward to offset payroll taxes that you will be paying. This election needs to be made with the tax return when you file the R&D credit application with the federal return. The rule of thumb is it's around 6.5% of the total amount that qualifies for R&D. Okay. So that's the federal R&D. There's a question from Raj, and it says, for the R&D credit, are supplies only consumables? Would 3D printers for prototyping count? Anything that would be considered a depreciable asset, something that's on your balance sheet that gets depreciated, does not qualify as a supply. Very good question. Okay. Another question, payroll tax. Does a C corporation startup need to register for payroll if the founders are not taking a salary? No. What if the founders are working in a state that requires minimum wage, e.g. California? If I was you, I would take a look at the California rules to see if there is actually de minimis thresholds to basically say, if you're a startup, are you still required to meet those requirements? Generally, I think they might be for employers of a certain number or more. I'm not an HR specialist, so if I was you, I'd reach out to someone who does payroll specifically. But I think that in the startup world, there's no possible way that you all can be paying minimum wages if you're brand new. So I think that there should be an exception there.
Okay, thank you.
Okay, no more questions there. So we talked about the federal R&D tax credit. The federal R&D tax credit, wages, supplies, independent contractors. It's part of the entity's tax return, and you can utilize that credit by making an election to offset it against payroll. In general, you should keep time records. That's something that in a perfect world, you should be doing, but this is actually an area that the IRS actually allows for estimates. So if you say, I'm paying Frank $100,000 for his salary, and 60% of his time is spent doing R&D. 60% of $100,000 is $60,000 doing R&D, right? That is the development of a product or process. That's what that is for, okay? Pennsylvania also has an R&D tax credit, and that credit is calculated based off of an increase year over year in the R&D spending inside of Pennsylvania, okay? This Pennsylvania R&D tax credit is applied for on December 1st in the year following the expenses, okay? And this credit can also be sold for cash at around 80 to 90 cents on the dollar, Okay. Again, free money. The only thing I'll say about these Pennsylvania credits, by the way, is if you as an owner or the entity for payroll is non-compliant in any way, shape, or form with Pennsylvania, if you owe 10 cents that is unpaid, they will send a compliance check out and deny your credit. What's the point? Open your mail. I've had clients who just don't open their mail and they've got these compliance checks and their credits get denied because they're not paying attention to these types of compliance checks. Pennsylvania will reach out to you if there's an issue, okay? But you need to make sure to pay attention to that after you apply and before they award it the following May, okay? Any questions about research and development? Raj had a good question about those printers, so I think that was great. Question, are you eligible for tax credits if you are a Delaware C Corp? Everyone's eligible for Pennsylvania or any other tax credits. The state of incorporation is irrelevant for these credits. It's where you operate. If you're operating out of Pennsylvania, you qualify for the Pennsylvania. There are actually state R&D tax credits across the country. Some states have it, some states don't. But if you are operating out of a state outside of Pennsylvania, that should be something that's looked into. Utah, Texas, they all have different versions. Yeah. Not that you care about Utah or Texas maybe, but I'm just pointing them out. Okay. All right. At the end, guys, we've been doing this for a long time. I know I gave you a lot of information and there's so many ways that you can save taxes or sell tax credits, but your goal is to do it right the first time and make sure that some of these little things add up to big savings in the long run. A startup might think that they don't have a lot going on, but I hope that I've pointed out to you that there is more that meets the eye. And sometimes what I do with my clients is I act more as a business advisor than I do just a tax preparer, because some of these items are not always just income tax related. There's sales tax in different states, there's income taxes, there's all kinds of things. But as you grow, you will find that it's really important to get all the little things right and making sure you're surrounding yourselves with good advisors who know what questions to ask when it's time is really the important thing there. So economics first, taxes second. You want to minimize your taxes, but you want to sleep well at night, okay? So think about what it is you're doing and where you want to go, and making sure that you have a good team surrounding you is a good thing there. With that being said, I'll open it up. Does anyone else have any other questions, concerns, things that they're wondering about? I'll leave our contact information on the screen for you guys if you wanted to in the meantime.
Will we get these slides?
I can forward them to Allison. She can forward them along if you want.
Yeah, that'll be really helpful. A quick reference guide.
No problem. Yeah. And like I said, too, keep in mind, tax law may or may not change with the Build Back Better bill that has been stalled. I haven't talked much about that because it's really, if I was to talk to you last year compared to this year, nothing is the same as what it started. So I didn't spend very much time looking at that kind of thing. Michelle mentioned that there's a lot to remember. I agree. But some of the things that I do and I talk about, I don't intend for everyone to remember everything. I intend for them to say, oh, wait, Carissa mentioned 1202. Let me take a look at the slides. Let me Google that. Just that phrase, maybe something about it rings a bell, because your goal is not to remember everything, because this is what we do. I'm a nerd, in case you hadn't noticed, to the nth degree, and I enjoy what I do. But you all have your own bread and butter. This is mine, and this is what we like to do. Well, question, what are good resources to find an accountant and how to qualify them? I think that there's many of them out there. I think that sometimes people will interview a couple and ask some of the same questions, see how they answer, how you get along with them. Being able to explain things in layman's terms is very important, but planning in my opinion, is probably one of the most important things for a startup, because you guys are moving a million miles a minute. And if you're trying to act reactively rather than proactively, it's too late, right? As far as resources, there's plenty of firms inside Pittsburgh. If I was you, I'd talk to your peers. Take a look, see who they're using. If you have any questions or anything like that, I'd be happy to help you and answer your questions, but talk to your peers. That's a good way to start. Or contact the presenters. That also works too. But again, I've been doing this, Megan, Dee, and I, we've been doing this for a while, and it's more of like a service to the startup community. We've been around the block a while, so we're not the right fit for everyone, but I hope that you guys can see that we know what we're talking about, right? So the purpose is for you guys. What other questions do you have? Thank you for those of you guys who turned on your cameras. I really appreciate a nod or a smirk in the background. It's really helpful when you're presenting virtually. So I do appreciate it. And you're welcome. Yeah.
All right. Thank you, Carissa, for doing this today, and Dee and Megan for coming as well.